Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. Over the past week, markets delivered mixed results as volatility continued. The S&P 500 and Dow ended negative, while the Nasdaq recovered slightly after recent declines. Market movement was primarily driven by a rotation out of technology and AI leaders as investors leaned towards profit taking and moving investments to defensive sectors like healthcare and energy. All of this was supported by strong earnings and a renewed investor interest. What we found was that economic uncertainty, the recent government shutdown, and cautious Federal Reserve signals continued to limit the risk appetite and raise market volatility. Now, on the other hand, in the bond market, Treasuries experienced a mild sell-off with the 10-year yields ending at around 4.15%. And we also saw that high-yield bonds saw pronounced weakness due to elevated supply and investor outflows. Much of this was attributed to spreads widening, notably towards the end of the week. We also saw municipal bonds remain quite strong thanks to new issuance and consistent demand, with many positive forecasts for municipal bonds through the end of the year. So let's talk about this in more detail, starting with our key market indicators this week. And we'll continue our discussion by reviewing the contributors and detractors of the market. Once again, highlighting the key market drivers and the key drivers of all of these indices in this past week. And we certainly want to make sure that we talk about how this will impact your portfolios in more detail. So with that, let's hop right in. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected 4% growth as of November 6th, which is slightly higher than it was last week, where we reported 3.9% growth as projected. Once again, no update on the unemployment data this week due to the government shutdown, but since the government is reopening, we're looking forward to seeing this data come together, and we'll make sure to share it as soon as it's available. Next, we're watching mortgage rates closely to see how home affordability is trending. This week, we saw upward movement in mortgage rates, where the 30-year and 15-year mortgage rates ended at 6.24% and 5.49%, respectively. Next, we'll look at investor sentiment. Now, one measure of investor sentiment is the bull-to-bear spread. The latest update shows the bull-to-bear spread ending at a negative 17.53%, showing that investors are feeling more bearish with the current market environment. Another measure of investor sentiment is the VIX, or Volatility Index, sometimes referred to as the Fear Index. Remember, VIX values above 30 are typically linked to large volatility resulting from an increased uncertainty or fear. While values below 20 generally correspond to stable market periods. This week, the VIX ended at 19.83. Next, we'll update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 45.8% probability of a 0.25% decrease and a 54.2% probability of no cut in December. The markets are starting to lean a little bit more towards a no cut in December, and this is specifically based off of this data. However, I'm sure we'll see more fluctuation in this data in the upcoming weeks as more government data becomes available. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 1.41%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was negative 2.72%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the U.S., was positive 0.78%. Well, the winner goes to international stocks this week. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. So with that, let's jump right into our discussion around contributors and detractors that moved these market indices in this past week. All right, so let's talk about the contributors and detractors for the past week. From the equity side, we saw investors trimmed positions in technology and AI stocks. Alphabet, Netflix, and Apple all saw declines, favoring undervalued sectors such as healthcare and energy. This rotation led to stabilization in the broader S&P 500 and outperformance amongst value stocks, despite volatility from late quarter earnings reports. Valuations concerns and macro uncertainty, including the aftermath of the shutdown and slow return of regular economic data, kept risk-taking in check. Now, on the bond side, we saw U.S. Treasuries sold off modestly as yields rose, reflecting disappointment over the Fed rate cut uncertainty and elevated inflation. High-yield corporate bond prices dropped as spreads widened as investors became more cautious. We also saw municipal bonds outperform, driven by supply heading into the holidays and solid reinvestment demand through December. Overall, this week's market reflected cautious rotation and a focus on sector diversification as investors responded to persistent volatility, some macro signals, and shifting flows between riskier stocks and safe haven assets. Thank you, everyone, for tuning in. But before I close out, I want to invite you all to a webinar hosted by Cage Rush, a CPA. He's our Chief Financial Officer here at Whitaker-Myers. This will be held on November 24th between 4 and 5 p.m. Now, as we approach the close of the year marked by significant tax law changes and shifting economic conditions, it's more important than ever to review your options and proactively plan for your tax future. This session will help individuals, families, and business owners understand the new rules, specifically with the One Big Beautiful Bill, so that you can maximize your potential deductions and take smart, actionable steps before December 31st. So join us for this practical, engaging hour where Cage Rush will share timely insights, address recent legislative updates, as I mentioned earlier, and answer your pressing tax questions, empowering you to finish 2025 with confidence and set a strong foundation for the year ahead. So register to attend this webinar by clicking on the link in the description below or visiting our website. So with that, friends, this concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful or informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. So with that, thank you so much for tuning in. We look forward to seeing you next week.